The allowance method involves a company setting up an allowance for bad debts and then writing off each uncollectible receivable. This allowance is estimated using historical uncollectible receivables. For example, we will record an allowance of $2,000 to start the year by debiting the bad debt expense and crediting the allowance for bad debts account. This will increase both bad debt expense and the allowance for bad debt accounts due to the allowance of bad debts account being a contra asset, which lowers the assets. We will then next record a $500 credit sale, which increases both accounts receivable and sales revenue. This sale will be considered uncollectible eventually. You then decrease both allowance for bad debts and accounts receivable to write off the uncollectible. This decreases both accounts. How is the allowance determined? Bad debt is estimated by a company through either the percentage of sales approach or the percentage of receivables approach. The percentage is chosen based off historic and expected uncollectible receivables for the accounting period. Firstly, we'll talk about the percentage of sales approach. For example, let's suppose net sales for a company is $70,000. From the previous year, the allowance for bad debts account has an excess of $450, which we start the year with. The company also expects 3% of its net sales will be uncollectible due to previous data. We calculate the allowance by multiplying the net sales by the estimated percentage to give us $2,100, which is the allowance for the year. The T accounts will look like this. We add this to account with no consideration for the existing balance. Thus, this method fulfills the matching principle best as it focuses on the sales for that accounting period only, but has no consideration for the net realizable value of accounts receivable. Finally, we have the percentage of receivables approach, which is similar to the percentage of sales approach but is based off receivables. Suppose a business earns $80,000 in receivables for the year and estimates 2% of those receivables to be uncollectible. We also assume the business has a beginning balance of $250 in the allowance for bad debts account. 2% of $80,000 in receivables is $1,600. This number should be the ending credit balance for the allowance of bad debts account. We then add the adjustment needed from the beginning balance to meet the $1,600, which we can find by subtracting the existing balance from the allowance found. The T accounts look like this. The consideration of the beginning balance is why this method is not the best for the matching principle, as it considers previous accounting periods, but considers the net realizable value of accounts receivables much better.